September 15, 2008. Lehman Brothers doesn't open for trading. By noon, the money market funds start breaking the buck. By evening, AIG is burning through its liquidity reserves. Within 72 hours, the global interbank lending system simply stops functioning. Not slowing, stopping. The ATMs keep working. The grocery stores stay open. But behind the infrastructure, the credit architecture of the modern economy has experienced cardiac arrest. 16 years later, we're told that crisis was contained, that the system learned that regulations fixed the fragility. But 2008 wasn't an anomaly, it was a preview, because the conditions that create financial crises haven't disappeared. They've compounded. Sovereign debt levels are higher. Derivative exposure is deeper. The distance between asset prices and underlying economic reality has widened, not narrowed. This isn't about predicting the next crisis. It's about understanding what actually holds value when the system that prices everything breaks down. Because in every major financial crisis across the past century, certain patterns repeat. Not because of ideology or theory, but because of how humans behave under systemic stress. Some assets evaporate overnight. Others lose purchasing power slowly, then all at once. And a small category maintains function, while everything else reprices. The difference isn't luck, it's structure. This analysis will demonstrate why certain stores of value survive coordination failures, while others collapse. Using the mechanics observed in 2008, the Weimar hyperinflation, the Asian currency crisis of 1997, and the Argentine default of 2001. Not what should work in theory. What actually worked when theory stopped mattering. Think of the financial system as a three-layer architecture. The bottom layer is real economic activity. The middle layer is credit. The top layer is speculation. In normal times, all three layers appear stable, but they're not equally real. The top layer is built entirely on confidence. The middle layer functions only when counterparties trust each other. The bottom layer continues regardless, because people still need food, energy, and shelter. When crisis hits, the system doesn't fail uniformly. It fails from the top down. The first thing that vanishes is liquidity in leveraged assets. In 2008, mortgage-backed securities weren't just falling in price, they stopped having prices altogether. Not because the houses disappeared, but because no one could agree on what the cash flows were worth when the models broke. Lehman held $639 billion in assets on its books. Within days of bankruptcy, those assets were being marked down by 70, 80, 90%. The assets still existed. But without functioning markets, without counterparties willing to transact, their nominal value became fiction. This is the core mechanism of financial crisis. Not destruction of underlying resources, but breakdown of the coordination system that assigns prices. Real estate survived 2008. Homeowners who could make payments kept their houses. But real estate investment trusts, mortgage derivatives, and anything requiring constant refinancing collapsed because they depended on credit markets that had frozen. The pattern repeats across every modern crisis. In Argentina 2001, the problem wasn't that farmland stopped being productive. The crisis hit because dollar-denominated debt couldn't be serviced when the peso devalued and capital controls locked everyone inside a shrinking system. Assets tied to credit availability fail first. Assets that generate actual cash flow independent of financing continue functioning. This creates the first filter. Survival in financial crisis correlates with independence from the credit system. But that's not the complete picture, because 2008 revealed a second mechanism. Even assets that generate real cash flow can become temporarily untradeable if they exist inside structures that require constant liquidity. Corporate bonds from profitable companies traded at distressed levels in October 2008. Not because the businesses were failing, but because the funds holding those bonds faced redemptions and needed to sell anything they could. Forced liquidation doesn't care about fundamental value. It cares about what can be sold today. Gold spiked in the initial panic of 2008, then dropped sharply as funds dumped it to meet margin calls. By early 2009, it had recovered and continued rising for 3 more years. The timeline matters. Assets that survive crises don't necessarily avoid short-term dislocations. They avoid permanent impairment. This is financial forensics. Studying past system failures to understand what survives. Not investment advice, not prediction. just the mechanics of how value persists when coordination breaks. The question isn't which assets go up during crisis. The question is which assets still function on the other side when the repricing is complete. Because the assets that fail aren't random. They follow a hierarchy of fragility. The first category to collapse is always pure speculation with no cash flow. In 2008, that meant structured products designed entirely around rising home prices. When the underlying assumption broke, the securities became worthless because there was no fallback value. The second category is leveraged ownership of real assets. You own something tangible, but you own more than it's currently worth, and your creditor demands payment now. Foreclosures during 2008 didn't happen because houses stopped being useful. They happened because homeowners couldn't refinance, couldn't sell at the inflated price they paid, and couldn't make payments when employment collapsed. The leverage converted a price correction into a survival crisis. Third, to fail are assets denominated in currencies experiencing stress. This was the lesson of the 1997 Asian financial crisis. Thai corporations held dollar-denominated debt while earning revenue in baht. When the baht collapsed, their debt burden doubled overnight in local terms. Profitable businesses became insolvent not because operations failed, but because the denominator changed. Each of these failures shares the same structure. The asset depended on something external, remaining stable. When that external dependency broke, the asset's survival became impossible, regardless of its intrinsic utility. Now contrast that with what continued functioning. Farmers kept farming through 2008. Energy infrastructure kept operating. People kept needing transportation, healthcare, food. The businesses providing those services didn't escape the repricing. Their stock values fell. Their access to credit tightened. But the actual operations continued because demand for the underlying service persisted. This reveals the survival mechanism. Assets tied to non-discretionary economic activity maintain function because the demand isn't optional. You can defer buying a new car. You can't defer eating. During the Weimar hyperinflation, German industrial equipment retained value even as the currency disintegrated. Not because factories were speculation-proof, but because productive capacity had intrinsic use regardless of what happened to paper marks. The pattern held in Argentina: land used for agriculture, machinery used for manufacturing, assets that generated actual goods people needed regardless of the financial system's condition. These assets repriced. They didn't disappear. But here's the critical limitation. Even productive assets fail if they're wrapped in the wrong structure. A factory financed entirely with short-term debt can be forced into bankruptcy during a credit freeze, even if the factory itself is profitable. The financial engineering determines survival more than the underlying productivity. Which brings us to the present structure. Global sovereign debt now exceeds $300 trillion. Central bank balance sheets remain at historically unprecedented levels. The derivative markets that froze in 2008 are larger today, not smaller. These aren't predictions, they're the current configuration. And the pattern from 2008 suggests what happens when this configuration experiences stress. The most leveraged positions fail first. The most complex structures become untraceable. The assets requiring constant refinancing face forced liquidation. What survives is what survived before. Assets with intrinsic utility independent of credit availability, productive capacity that generates necessary goods regardless of financial system stability. Stores of value without counterparty risk. But survival doesn't mean comfort, it means function. The households that weathered 2008 weren't the ones with the largest investment portfolios. They were the ones with no debt, liquid reserves, and income streams that didn't depend on credit-fueled consumer spending. That's not ideology, that's observed behavior during system stress. The synthesis is simple. Financial crises don't destroy real economic activity. They destroy the coordination mechanisms that price and finance that activity. When those mechanisms break, value doesn't disappear. It reprices violently toward assets that function without the mechanisms. Understanding this doesn't require predicting when crisis happens. It requires recognizing the structure of dependency. If your wealth requires stable credit markets, functional derivatives, pricing, or continuous access to leverage, that wealth is structurally fragile. If your wealth is tied to actual productive capacity, has no financing dependency, and serves non-discretionary demand, it reprices but continues functioning. The difference determines what you still have when the coordination breaks. September 15, 2008. Lehman Brothers doesn't open. At the time, it looked like institutional failure. Poor risk management, excessive leverage, regulatory capture. But 16 years later, the structure is clearer. Lehman didn't fail because it was uniquely reckless. It failed because it was purely a coordination mechanism. Remove the confidence, remove the liquidity, and there was nothing underneath. No factories, no farmland, no cash flow independent of market function. Just positions that required the system to keep working. 2008 wasn't a warning about one bank. It was a demonstration of what happens when assets exist only as agreements. The agreements held until they didn't. What survived was what didn't need the agreements to function. That pattern hasn't changed. The scale has.